We're in conversation with Indranil Sengupta of CLSA on his latest take on how the rates both in India and US may actually pan out from here on, given the change the macro scenario is actually taking place. Indranil, thank you very much for your time. So, the latest commentary coming out of from the FOMC minutes seem to be suggesting, and markets seem to be readying for higher rates for slightly longer. What is your own estimate regarding that? How much higher and how long? And is that priced in right now in markets, bond markets as well as equity markets globally, or not yet?
So we do see upside risk to the 5-quarter that the Fed dot plot had, and we are not certainly seeing any cuts in 2023 by the Fed. In fact, we think that it will be maybe somewhere slightly later in 2024 that the Fed will be able to cut, because core inflation, in our view, will average about 3% odd in 2023. So the scope for the Fed to cut very quickly, does not seem to exist.
Mm-hmm. The way bond yields globally have been edging, be it the 10-year or the 2-year, what is that pricing it right now in terms of interest rates there in US, in your view?
So I think that bond markets are far more optimistic than the Fed. If you look at the US 10-year, it traditionally has a 100 basis point premium to the federal funds rate. Now it is almost 100 basis points below the federal funds rate. So even assuming some degree of inversion of the yield curve, clearly bond markets will need to reprice higher if the Fed sticks to even the 5-quarter, not to speak of further hikes beyond.
Right. What about back home in India? Because if, the meeting minutes coming out from the previous meet here also seem to be suggesting that on the one hand there are growth-related worries, but inflation may remain sticky. How much upside to the risk rates are you factoring in for India?
So our base case is that the RBI will hike to 6.75 if the Fed stops at 5-quarter. It will go to 7 if the Fed goes to, let's say, 5.5 to 5.75, and maybe the RBI goes to 7-quarter if the Fed goes to 6. So ideally, I think the RBI will want to maintain a 200 basis point gap between the repo rate and the federal funds rate. But if once the Fed says that, okay, we are likely kind of stopping, pausing from here on, the RBI will get some more leeway. But otherwise, it's very important to have a sufficient differential with the Fed. Otherwise, why will anybody invest in India in the when you get better dollar returns?
Right. How are you looking at the data coming out of high frequency indicators, which seem to be suggesting the quality of growth there in US? Because on the one hand, the earnings and the guidance seem to be suggesting that things are weak, but jobs data, CPI is sticky, a lot of real estate data is not turning out as conducive, which may be suggesting that there's reason for Fed to go slow.
Yeah, so that's what I'm saying. So there are clearly, upside risks to the 5-quarter that the Fed has in its dot plot.
Mm-hmm. What about back home in India? Some strategists believe that perhaps the policy makers are overestimating growth, and actual slowdown globally will also start impacting growth here. Our estimates are slightly on the higher side. Or do you think it's the kind of growth numbers which have been mentioned in the budget, or even RBI commentary, Governor Das's commentary earlier, they are fair on growth, and we continue to have much robust growth than rest of the world?
So I'm looking at 5.5% growth next year, which is obviously below the official forecasts. But then, again, the second part of the statement holds true, that it will be better than most countries in the world.
5.5 is pretty on the lower side compared to all the other estimates which are out there. What are the bases and lower than consensus growth estimate, and what do you think will weigh on growth?
So I think two things. Number one, as the Fed keeps tightening and global demand comes off, that is going to affect export demand. We have seen that in the past, US recessions have cost about 100 basis points of GDP. So that is number one. Number two is that as the Fed keeps raising rates and we are following, so lending rates are also going up. So that's number one. Number two, lending rates are going up even faster for small industries, vulnerable sections, because their lending rates are linked to the RBI. What we call the external benchmark linked lending rates. So when the RBI cut, the idea was that they should cut. Now that the RBI is raising, you have a double whammy there. The third point I would make is that real lending rates are going up much faster than nominal lending rates because WPI inflation, core WPI inflation is coming down. So it's just not that the lending rates are going up by whatever the RBI is raising, but because you have WPI inflation coming off, you have a much higher increase in the real lending rate.
Indranil, this rates in our system, the real lending rates in our system, in our economy, edging higher, is also likely to have an impact on cost of capital of corporate India, borrowings, etc. If the third quarter gone by was any guide that the margin and profitability was under pressure for corporate India, you expect that next 1 or 2 quarters, similar kind of a scenario could play out, because bulk of the higher rates actually show with a lag uh, among the users.
Yes, I do. Yes, I do. But then, it also depends in which segment of the economy you are in, because if you are in a segment that is using, commodities, then, the impact is somewhat lesser because commodity prices are also coming off, at least relative to last year. So it depends on where you are. But then, yeah, on the whole, borrowing costs are headed higher. Real borrowing costs are headed even higher.
Okay, let me talk to you about how do you see the demand panning out in India. We keep talking to a lot of corporates and paint companies, innerwear companies, footwear companies, segment after segment, consumer goods companies are showing anemic volume growth and margin pressure. And this seems to be suggesting that people are postponing their buying decisions or even downtrading across categories. This is not a good sign for demand. Do you see this remaining a worry for some time in the system?
Yes, I think higher lending rates often lead to slower demand. I mean, that's basic theory. The other issue here is that we think rural demand is slowing. We are looking at about, I think, 8-10% increase in farm income during the coming Rabi crop. There's also talk of a El Nino as we move ahead to the next, the monsoon season and the Kharif crop. So there is pressure on both urban and rural demand. Uh, so there is pressure on overall demand.
Let's talk about a little, beyond the 3 to 6 month period. There is also your expectation that the second half of this calendar, going into 24, a series of rate cuts actually may start there in US, and hence we'll see a lag effect here. Are we talking about? So, what could be the quantum of those rate cuts, and how much probability would you assign that they may start in the second half of this calendar?
So second half of this fiscal at the earliest, really, or next year. So, I think once the Fed is done, the RBI will probably be able to cut to 5.75 or 6%. Given that we expect inflation to come off to around 5.5%. Now, when they are able to begin to cut, I think also depends on when the Fed pauses. So, for example, if the Fed were to pause in May, I'm sure the RBI can start by October. If the Fed goes on till July, the RBI may have to start from February. So, and I think the quantum of cuts baseline, if the RBI goes to, let's say, 6.75, maybe it cuts 100 basis points. If it has to go to, 7, then it cuts 125 basis points. So, however, from you go from, let's say, a 5.75 repo rate, however higher you go, it's easier for you to cut, because the Fed has right now penciled in 100 basis points of rate cuts in 2024 and 2025. So once the Fed stops, the market will begin to price rate cuts throughout the world, and that will give RBI the headroom to begin cuts earlier, because our inflation is not certainly as nowhere close to as challenging as US.
Right. And one last question: where do you see, after this growth of 5.5% next year, do you see that trough out going into the year after that to 6%, etc., and beyond?
To 6.5.
6.5.
We are looking at 6.5.
Right. All right, Indranil, thank you very much for explaining all of that, and thanks very much. Our viewers will really put these inputs and will be able to utilize it in their investing strategy and macro strategy. Thank you so much for your time.
Thank you.